Hello, everyone, and a warm welcome to INSEAD 2020 SDG Week. My name is Ketel. I head the Hoffman Institute at INSEAD, which has for a mission to integrate sustainability into everything that the school does. And I'm going to be your host today. And I'm going to share this privilege with my friend Aubrey. Hi, Aubrey. He's
Hi, Kel.
joining you from Singapore. I'm based in Fontainebleau, where we have our two campuses. And Aubrey is a 20D, MBA 20D student. For those of you not from INSEAD, that means that he's an MBA student who will graduate next month. He's also the president of our Endeavor Club. And this SDG Week is organized by the Hoffman Institute with Students Club, which is why the two of us will be co-moderating this event. So today we'll be talking about impact, and more than today, also for the rest of our SDG week. And it's my pleasure to welcome our Dean, Ilian Mihoff. He's here to introduce the SDG week and also our session guest. So in addition to being INSEAD Dean, Ilian is a professor of economics here at INSEAD, and he's also the academic director of the Hoffman Institute. So this is why he's best placed, with all these hats, among many others, to join us now to introduce the SDG Week, the 2020 SDG Week at INSEAD. Over to you, Ilian.
Thank you, Ketel. I'm not wearing any hat now. I'm just an enthusiastic supporter of the SDG movement, and I'm so happy to welcome all of you to this webinar dedicated to our second Sustainable Development Goals Week. This year, the SDG Week is online. It is a pity that we cannot be together like last year. But at the same time, we tried to make the most out of this. And we decided, let's invite more people. And normally we would have on our campus celebrating the SDG movement. So we could invite our alumni, partners, and friends from all over the world. So welcome to all of you. So why do we have this SDG Week at INSEAD? We started it last year. It was our first year with a dedicated week to bring awareness about the Sustainable Development Goals. And as you know, these goals were adopted by 193 countries in 2015. And they set 169 targets that we have to meet as a global community by 2030. So we have 10 years left, and we have a lot of work to do. As you know, at INSEAD, we have been embracing this framework of the Sustainable Development Goals. And also, as you know, I have been talking a lot about business as a force for good. And when we talk about business as a force for good, we're basically talking about businesses using the SDGs as a compass to intentionally contribute to better outcomes for people and the planet. So this week, the SDG Week, is a moment for all of us to explore what that means in theory and in practice, so that our students and members of our community are better equipped to bring sustainability at the heart of their organizations. This year, because of this online format, we have almost 2,000 people who have signed to 7 events that will be held in the coming 3 days. In partnership with 8 student clubs, Accenture, Strategy, and several faculty members, we will have conversations on impact investing, careers in sustainability, impact entrepreneurship, and equity, diversity, and inclusion. They're all open to registration, and registration is free, so please do sign up. I'm very happy also to have Aubrey here as one of our co-hosts, because as you know, at INSEAD, Endeavor and the impact movement is really has a long tradition. We were one of the first, if not the first, business school in the world to create a club dedicated to social impact in 1993. Very importantly, for me actually, it is a very significant moment that for this week, we have a special honor to welcome Sir Ronald Cohen to open the SDG Week. Ronnie is a chairman of the Global Steering Group for Impact Investment and the Portland Trust. Many of you know that he's the co-founder and former chairman of Apex Partners, one of the largest private equity companies in the world, and he was leading this company for many years. He's a preeminent international philanthropist, venture capitalist, private equity investor, and social innovator. If you go to various Wikipedia sites, you will see that he's very often considered to be the father of impact investing or the father of social impact, it is truly an honor to have him here. For many of us, for me, he is a clear inspiration that we can definitely do better in the way that we manage our businesses. So this year, amidst all the calamity coming from the pandemic, Ronnie managed to publish a book called Impact. And I strongly recommend that all of you read this book, because at the end, the only thing that you'll say to yourself, I just have to do more. It is so inspiring and so inviting to action that you feel recharged and energized. We do have it in our library, so you can also borrow it and read it in the bookstore. But it is a fantastic book. And I now want to give the floor to Ronnie, but let me actually start with two questions. That I have known Ronnie now for 3 years or so, but I still don't know the answers to these questions. So I would like to ask him now, so that all of us learn. First of all, he started in 1972 as a venture capitalist, private equity investor. And then at some point, Ronnie moved to become one of the biggest promoters of impact investing. So the first question is, what led you to this change of heart? It's a big leap, and especially because you did it at times when people were not still paying attention to impact investing as much as they are today. And the second question is about the book. You talk about an impact revolution and argue that it can transform capitalism. Now, I've read the book, but I think that for those who are listening to us today and watching us, in order to whet their appetite for the book, can you briefly explain to us, how does it work? How will the impact revolution transform capitalism? And what is your main thesis? So with this now, to Ronnie, welcome.
Thank you. Thank you very much, Ilian, for this very warm introduction, which I heartily reciprocate, because it's been a pleasure over the last 3 years to exchange ideas with you. And it's also a pleasure to exchange ideas with the broader INSEAD communities. And it's a wonderful coincidence of timing that we're speaking at the time of the INSEAD SDG week. So to answer your question, Ilian, I actually got into the venture capital business. I started in 1972 in my mid-20s at the age of 26, because I thought I could do something that was socially useful as well as make money. I needed to make money. My parents, as some of you know, had to flee from Egypt with me and with my brother in 1957, when I was just over 11 years old. And they had to remake their lives in Britain, and I knew that I would have to take some responsibility for making sure that they, could lead comfortable lives. So I knew I had to make money, but I wanted to do something that was socially significant. And venture capital at that time looked like the opportunity to create jobs. It turned out to be an opportunity to create huge numbers of jobs. And so for me, the original decision was based on a social purpose. But then as Apex grew and more of the entrepreneurs we backed made money, I began to feel that instead of closing the gaps in society, which we were all talking about doing, equality of opportunity and so on, in fact, those gaps were getting bigger and bigger, both economic and social gaps between those who were born into families which faced major challenges, where perhaps the parents were unemployed, might have a drug habit in addition, and those who had a fair chance in life, as I was privileged to be given, to do good and to do well at the same time. And so, by coincidence, at the beginning of 2000, I received a phone call from the Treasury saying that it was the UK Treasury. It was very concerned about how it was dealing with the issue of poverty. And this started me, Ilian, on a 20-year path to our meeting today. Because as I began to look deeper and deeper into the issue of how we tackle social issues, I began to realize that we couldn't hope to accompany governments in tackling social issues as philanthropists and so on, if we didn't actually bring investment into the picture. And this brings me to the second part of your question, because we invented some new securities. We invented the social impact bond, where the return depends on achieving a social goal. The first one, as most of you know, the Peterborough bond, had to do with reducing the number of prisoners who go back to jail after their release. And for those who don't know the social impact bond, the contract with the Ministry of Justice had certain milestones in it. In the event we hit some of those milestones, we achieved a 9.7% reduction in the more than 60% of young prisoners who went back to jail in Peterborough prison. And the investors got their £5 million back, which had been used to fund charitable organizations working with prisoners, as well as a return of 3.1% a year. So we invented the social impact bond, but then I began to realize, as impact investment progressed, that the social impact bond exemplified something much more fundamental. It was a security which, for the first time, optimized risk, return, and impact. For the first time, we had a way of attracting investment to entrepreneurs who wanted to improve lives. And I began to realize, as I chaired the G8 Social Impact Investment Task Force in 2013 and 14, and then in the 6 years that followed that, as we built up the global steering group for impact investment to continue the work of the task force, that this concept of risk, return, impact was actually one that was being adopted by our economic system. And I'd like to just explain what that means. We could see through the work of the G8 task force that the values of young people like yourselves were changing, that they were stopping their purchases from companies whose values they don't espouse. They were refusing to work for these types of companies. And investors had become aware of this. And they were aware increasingly of the fact that this had implications for the profitability of the companies in their portfolios. And so investors, many of whom were in any case sensitive to the environmental and social challenges that we failed to meet, also began to shift their money away from companies that did harm. And today, ESG investing represents $30 trillion. That's more than a third of professionally managed assets. Impact investment proper, which measures the impact created, will hit this year $1 trillion. Now, in 2014, when we published the G8 Task Force report, we had a chapter entitled The First Trillion. We didn't think this could happen in as short a period as 6 years. To many, it seemed fanciful that it could ever happen, but it did happen. And so today, we have more than 30% of money, professionally managed money, which is going to achieve impact as well as profit. And I began to realize, Ilian, as I explained in the book, that technology and big data was enabling us now to measure the total impact that companies create, the impact they create through their operations on the environment, the impact that they create through their employment on people, and the impact that they create through their product on both. And I can go into greater detail, but the balance of opinion today has shifted in the direction that I'm talking about. We can no longer continue as companies to make profit without worrying about the damage that we're causing. You can see investor rebellions at the Procter & Gamble shareholder meeting a couple of weeks ago. 2/3 of shareholders voted against Procter & Gamble's management because of the deforestation that was being caused by P&G's use of palm oil. So, in summary, bringing impact to the center of our economies alongside risk and return is now possible because of impact transparency.
Thank you, Ronnie, for laying out your thesis and also for highlighting the opportunity that we have in front of us right now. As we are having that conversation during our SDG week, and Ilian just mentioned, we have these 17 goals, 169 targets by 2030. If we put that impact revolution next to the sustainable development goals and this imperative for global positive impact, if we may, how do these two agendas relate, and why do we need one for the others?
So, Catel, very, very nice to be on the platform with you to chat about this. It's the only way of achieving the SDGs. There's no other place that we can find $30 trillion to achieve them, but in investors' pockets and in the coffers of companies. So this impact transparency has now been taken up by UNDP, which invented the SDGs, as you know. And I sit on a committee that is supporting UNDP's efforts to bring impact transparency. Because when you have impact transparency, Catel, you can link every line of your P&L to an SDG. You can see who is aggravating an SDG and who is helping to achieve it. And you can see it in monetary terms. So yeah. I actually think that that 30 trillion, which is already present in, in equity and bond markets and in impact investing through venture capital, private equity, real estate, and infrastructure, that money, if it can deliver real impact because it can make decisions about which companies to invest in on the basis of real, dependable, audited information about the environmental and social impact of different companies, that money, which is growing, which eventually will encompass all of investment, is the way for us to achieve the SDGs.
Thank you. And as you articulate in the book, actually, the needs to achieve the SDGs is equivalent roughly to 30 trillions as well. So we have that match here in terms of what can help to achieve the rest. So let me get a little bit into the technicalities here of what you started to mention in terms of how we should account for contribution to the SDGs. You promote the concept of impact weighted accounts. Can you tell us what that means? And can you give us an example of how that's being calculated and taken into account by a company, just to be very specific?
Yes, good. So I chair an effort at Harvard Business School, where I did my MBA, which is called the Impact Weighted Accounts Initiative, as you say. And we just published the data set, which all 600 of you on this webinar can go to and access under IWA, which shows the environmental impact created by 1,800 companies. Now, Catel, if I say to you, out of these 1,800 companies, 250 of them are actually creating more environmental damage than they're making in profit in a year. And if I say to you that more than a third of the companies, more than 600, are creating environmental damage that is greater than 25% of their profit, that begins to explain what this impact transparency is about, right? And if you look at employment impact, we've published some papers on that, and we've published comparisons of a handful of companies, but soon there'll be hundreds and thousands of companies with their employment impact, all based on public information so far. You take a company like Intel, and you look at its wage bill in the US, $7 billion. You say, great, fantastic potential positive impact, right? But then if you compare the diversity within Intel with the diversity outside of Intel, and if you ascribe the salary levels that would have gone to members of these excluded communities, and if you look at differences in gender pay and advancement and so on, it actually reduces by half to $3.5 billion the positive employment impact that Intel creates. And Intel is a leader. So imagine if you had transparency on the whole high-tech world about its employment impact. And when it comes to product impact, technology enables us, to put it simply, to scan a barcode and look at all the ingredients in a product and measure the health impact of saturated oils or sugar or whatever, and similarly arrive at numbers. So we are basically saying we've spent several decades looking at metrics, CO2 emissions and so on. We now have the data, broadly speaking, not enough of it, not audited, but broadly speaking, we can see the total picture. And what we're creating now is a path to the monetization of these impacts, which you can then include in the profit and loss statement or in the balance sheet in the way that I've been describing.
Yeah, and so that's several points here that come to mind. One, again, to reiterate the importance of the Sustainable Development Goals, which for sure are many, but that help you as a set to make sure we don't harm with one hand and do good with the other one, right? And then again to follow what you're saying in terms of the importance of measuring the full account. Just account for human capital, account for environmental capital, and monetize it to then integrate it in P&L, for instance. Yeah. Now they are, and that's when some of our listeners here, such as Luc, are mentioning the fact that on the metrics front, there are plethora of initiatives. Pretty much every ESG system is one of them. In addition, we also are starting to see, in addition to the impact-weighted accounts initiative at Harvard, other initiatives that are trying to bring together actors that are dealing with reporting, with accounting standards, that are coming together to try to harmonize and bring a little bit of, let's say, clarity in this complex landscape. Who, in your view, should take the lead? And how should that organization bring about others so that we get to a standard, if this is what we need ultimately?
Excellent, excellent question. I'll answer it at two levels. At the first level, I would say that the plethora of efforts, I mentioned 150 serious ones in the book, have really focused on creating the pieces of the puzzle. Mm-hmm. But we haven't had a picture on the puzzle. So SASB, the Sustainable Accounting Standards Board, has been measuring the metrics, CO2 emissions and so on. GRI has been talking about company reporting in more qualitative terms. We are putting, with the Impact Weighted Accounts Initiative, the picture on the puzzle. The picture has to be impact weighted accounts because they're easy to use. You can use all the tools of financial analysis that we're used to using. You can look at impact weighted earnings per share, Sharpe ratios, or whatever else you want. Investors know how to digest it. And therefore, they are going to be, in my view, the way in which companies will be made to report. And that comes to the second level of the question. If you look at the Harvard data, Cattell, you already see that this impact information is price sensitive. You can see a correlation between the value of companies that pollute more and lower stock market ratings, lower PE ratios, basically, within certain sectors. Now, when you have price sensitive information flowing unevenly, what happens? Regulators have to step in. They have to protect investors and make sure that all investors have the same data. And that data has to be reliable. It has to be according to accepted accounting principles, which are audited, with numbers that are audited. And so you can begin to replicate what we have with financial reporting, and you begin to shift investors to judging and valuing both the profit and the impact that companies create. So I think it's inevitable now, with this information flowing, that regulators will have to step in. And it is not a coincidence, Cattell, that we've had the IFRS, which is responsible for accounting outside in the whole world outside of the USA. We've had the International Organizations of Securities organizations, which is responsible for regulators across the world. We've had the World Economic Forum, all come out in the last few months saying they have to look at sustainability accounting. And so I think we are now going to find a convergence, which is going to push us to the mandating by regulators in some countries initially, eventually, as happened with financial accounting across the whole world, that impact-weighted accounts have to be published by companies starting 3 years from now.
Yeah, thanks for this. And in the book also, you bring this historical perspective on how the world came up with generally accepted accounting principles, right? They didn't come out of nowhere. These are social constructs, and there are organizations publishing them. So now basically you're arguing to take the next step forward in terms of considering impact. Now, in that process, the role of government was key. And that's also some questions that are popping up here with our audience. While we put the emphasis on the role of business, standards, global guidelines are defined by government and intergovernmental process. So how do you see their role now, in particular, as we need to accelerate progress?
So I think we can learn from the historical parallel to which you refer, Cattell. In 1929, after the crash, investors woke up they realized that they had been investing in companies without transparency on the profit they make.
Mm-hmm.
Why? Because every company in those days could pick its own accounting firm and its own accounting principles, and there were no auditors to verify the numbers. Okay? In 1933, we had the first piece of legislation in the world mandating in the United States generally accepted accounting principles and the use of auditors. Now, at the time, people argued it's impossible to have a single set of accounting principles for every company in every sector and of every size. And then they argued, well, if you did have it, it would spell the end of American capitalism. Mm-hmm. Right? And today we have the same sort of of pushback, with a lot of companies arguing that this is going to cause them terrible harm, and a lot of investors arguing that this is going to be impossible to achieve. But we have computing and big data, and the Harvard effort proves that we can measure on a comparable basis. And so I believe that the urgency that COVID has created will accelerate the move to impact transparency. And if all of us on this score do our bit wherever we are across the world to push our thought leaders and our political leaders to understand that they need this impact transparency, because coming out of COVID, our governments are going to be short of money because they have taken on so much debt. And our social issues are going to amplify hugely because of high levels of unemployment, consequential homelessness, poverty, and so on and so forth. And so the New Deal that our political leaders have to bring us now is to bring companies and investors to achieve positive societal and environmental improvement. And our financial markets have already adjusted, as I was saying earlier, to that idea. So actually, the train has left the station. And so if governments realize this earlier and their regulators realize this earlier, they can actually bring this transparency immediately into use and help to cope with the consequences of COVID, making our recovery quicker, fairer, and more sustainable.
So we're seeing in some parts of the world, some part only for now, but let's see what's happening today with the election in the US. What we're seeing is that some part of the work, like in Europe, we have some, green recovery and Green Deal push as part of the recovery system. Are you here arguing for that to also integrate some reforms on the reporting and accounting front for companies as well?
I am arguing that we should not stop with reporting. We certainly shouldn't stop with voluntary reporting, where the European Union has been working. It has to be mandatory, but reporting will not change the behavior of companies. And it's companies that are creating environmental damage, not governments, and many social issues too, through their pay policies and so on. So we need to integrate in our thinking reporting through financial accounts, impact accounting, and we need to transform the push for a greener world and the push for greater reporting transparency. We need to transform that into a push for full accounting transparency on impact.
Thanks, Ronnie. I think you make the case strongly, and we see the opportunity now, even though we are in the middle of a crisis. I'm going to hand over to Aubrey, my co-partner here, who's been gathering questions from students. Over to you, Aubrey, and I'm going to sift through those of our audience while you do that. Thanks.
Great. Thanks, Catel and Ronnie. Thank you again for joining us here. Much appreciated. So, as Catel mentioned, we've got a lot of very interested INSEAD students here who wanted to ask you quite a lot of questions if we had the time. I think I'll start with one. So this year, members of our INSEAD Endeavour Club have actually managed to set up the INSEAD Social Impact Fund, which is a first for INSEAD. So yourself as a serial founder and entrepreneur in the impact space, what advice would you give to anyone looking to sort of start their own impact investment fund? You know, the practitioners in the space, what do's and don'ts could you recommend?
So first of all, I think it's the future. I think if I were 26 today and wanting to enter the venture capital industry, I would be an impact venture capitalist. I think risk return impact will deliver better returns than optimizing risk return, because you affect both the risk side of the equation, talent leaving you, customers leaving you, investors leaving you, the risk of regulation and taxation on the one hand, but you also open the door to new sets of opportunities, often to provide services or products to underserved markets, which are huge. And I can give you some examples of that. So the first thing that I would say, if you're going to be creating an impact venture capital firm, is to recruit people who are convinced that that is going to deliver better returns. When we started out, people were saying, well, maybe this will be a discount to normal returns. That's not the case. You need people to enter the industry who firmly believe that they can deliver superior returns. And if you look at a company like Tesla, where Elon Musk entered the automobile industry, not because he thought the automobile industry in its current form provided a big opportunity for profit, but because he could see that a disruptive model in that industry would enable Tesla to achieve leadership of it. And today, Tesla is worth more than General Motors. You know? Why? Because there are consumers who don't want to buy polluting combustion engine cars. Right? So find entrepreneurs to back who have found the big issue that they want to contribute to solving and have defined a business model where the more impact they deliver, the more money the company makes.
Thanks, Ronnie. So I mean, I think you were the pioneer in this space. You've created these impact funds, and in the last sort of 15, 20 years, we've seen many more people follow in those footsteps. And as you mentioned, we can have this sort of lockstep approach of impact and earn profit. Impact investing is now very much in vogue. It's very sexy, and I think this is a great success that we've got the industry to this place. However, as we don't yet have these impact-weighted accounts that you're pushing, I think the risk is very real in the meantime of sort of impact washing, damage to the sector credibility. So the question here from the students is really, how can the industry sort of manage this transition period and condition itself so that impact investing is relevant for the long term and not just a short-term fad?
Okay, so I think the key to getting there quickly is for investors to clamor for transparency. Because investors today who are connecting with the Harvard data, and some big investment firms are beginning to use this data to make investment decisions, but not everybody's aware of the existence of this data. So you could argue that the fact that they can identify that Procter & Gamble, to which I referred earlier, is delivering $1.7 billion of environmental damage in a year, which is equivalent to more than 10% of its profit before tax and depreciation and so on. It's EBITDA. That information is material. If we believe that people will stop buying products because companies are polluting, and that information is beginning to circulate, then the earnings of Procter & Gamble could be affected by it. And regulators don't tend to lead Aubrey. They tend to follow. They follow when they feel that the disorderly market is being created, which disfavors some investors. And so we need investors to to raise their voices now about the need for this impact transparency. And if we can achieve that, then it'll happen that much faster. In any event, I don't think it's going to take more than 3 years to get there. I think as this information, and we are increasing the amount of information that we're making available, there are other efforts that will attempt to do the same. As that information begins to flow, the situation for regulators will just require them to act.
Okay, thanks for that answer, Ronnie. And we had another question from the students more about your personal journey. So, you know, you've now had this 15 to 20 years experience in the impact investing space. Some students were very interested to understand, you know, were there any, you know, regrets you had in this period? Is there anything you think you would have liked to have done differently over this journey you've had in impact investing?
I think the initial disappointment I had was that governments were so slow to understand the importance of this. I think now things are beginning to change a bit. We can see the EU beginning to focus intently on this issue with the challenges of stopping at the reporting at the moment rather than going through to impact accounting, as I was saying. You can see several governments beginning to think about it. I don't know that we could have done anything differently, because I think governments like regulators, which are an emanation of government, government also tend to follow the consensus, the popular clamor, rather than to lead it. I think over the last 20 years, you know, there's a wonderful Spanish proverb, which, well, something that a Spanish poet called Machado, 19th century poet, wrote, which says that the path, there is no path, the path is made by walking. And we've basically walked the path of impact investment. We've invented as you know, as we progressed, and it's now leading us to impact economies. I think it's happened very quickly relative to, you know, relative to other things. I think if you're launching out to raise money for an impact venture fund now, you have a much better shot at raising it than even 5 years ago. If you're an entrepreneur with an impact venture, you have a much better shot again at raising money from venture capitalists. I think the trend is our friend.
Look, I think the governments always we always love them to move faster, but I do agree with what you say, that, you know, this initiative has really taken off in the last 5-10 years. So perhaps this was something you observed earlier in your career, but no, I think we're in a really good space. So we're going to be taking some questions from the audience now, and the first one I'll pose to Ronnie has come from Andre, and Andre asks, you know, is regulation enough? How do we enable managers to make the right decisions about asset allocations or risk management? Don't we need management tools as well, and not only reporting metrics?
So I believe very firmly that the monetization of impacts are a very important management tool. To the extent that a company's products or its employment practices or its operational footprint creates social and environmental damage, and its valuation goes down as a result of that, we're going to see companies focusing on impact-weighted earnings per share. And that they're going to begin to take measures to change their employment practices, their products, and their operational footprint. I was asked on an interview in the United States on television on Friday, look at ExxonMobil and how its value has dropped. It's dropped, in fact, from 500 billion 3 years ago to 140 billion today. Now, if you look at in the book, I mentioned that ExxonMobil creates $39 billion a year of environmental damage in comparison with 22 billion for Shell and 13 billion for BP. And if you look at what's happened as the value of these fossil fuel companies has declined, what's happened to renewable energy companies, they've shot up. Mm-hmm. So we already have a mechanism in place, which is the financial market, for driving the behavior of companies. And the tool of impact transparency through accounting is important both from the company's point of view in maximizing its own impact, and also from the point of view of investors and consumers and employees and government who are concerned about the externalities being created. So I believe that impact accounting actually reconciles these two streams of analysis which have gone on for some years and which are still reflected in the IFRS consultation paper, for example.
Okay.
Thanks. Let me just jump in to ask some questions and take a handful of them that our audience are asking. And one has to do with the downsides of the disadvantage of the approach that you're proposing, any criticism that we have, so that we have an open discussion. It's clear that myself, Aubrey, and Liane, we all here happy campers with you on that. But what are the key criticism? And then, and that's asked by Eric and others. And then Natasha, connected to that, is asking us, if you're not bored with, as a leader, with a sustainable mindset, what do you do to shift and to get there? So that's also connected to the question about how do you convince the skeptics and how do you change mindsets?
Okay. So answering the second question first, I think you have to convince them through performance. Year to date, ESG investing has outperformed non-ESG investing. Some people do impact investing for moral reasons. Some people do it for prudential reasons. A market is made up of both. And I think this will outperform. And that's how you're going to convince the skeptics. Just like those who didn't believe in technology were left behind, those who don't believe in impact are going to be left behind. Automobile industry has had to catch up with Tesla as an example.
Ronnie, can I?
Yeah.
Sorry for interrupting you. Can I push here a little bit further and play the devil's advocates? Because in terms of evidence, at least at the academic level, the question is still on the table. There was one of the studies that was published at the end of August by researchers from University of Waterloo, Tilburg, and NYU, actually show that ESG investment didn't outperform more traditional investments, including during time of crisis, as it had been demonstrated by other group of academics before. So you see what I'm saying? I want to push a little bit here to say that we don't yet have all that evidence, it seems.
No, we don't have all the evidence, and we didn't have all the evidence at the birth of venture capital. At the birth of venture capital, most people thought that funding on a 10-year basis with no running return, young entrepreneurs who want to change the world, to disrupt industries that had been around for a century, led by behemoths, was going to lose money. We had to argue, I remember the phrase, if we jump over a precipice 20 times without falling, does that show it's risky? You know, that's how we were persuading people. And the big investors, the AT&T pension fund, which was led by a towering figure called Tom Judd, which was one of the first to invest in venture capital funds. When it was asked, why are you investing in it? Can you prove it's going to work? We'd say, we can't prove it's going to work. We have faith. And I think that's what the market is made of. If there are people who are skeptical about it, let them not invest. Let them continue to invest in fossil fuels. Good luck, you know? So I don't think this is a debate. I think this is now a new investment theme it is in line with the values of new consumers and new investors. It is way beyond tipping point, which is usually viewed as being 10% of a market. It will take time to prove that it works. But I believe as an investor that you have a better shot at delivering superior returns this way than just risk return. And you don't have to just believe me. You look at the other leaders of the private equity industry, the most skeptical of the most skeptical, the most capitalistic. They're all coming into this area, whether it's TPG, KKR, Blackstone, Bain, Partners Group, Apollo now, everyone is moving into the area. So you can either think this is a smart money moving in a new direction, or you can take the view this is a flash in the pan. I don't mind which view you take. I know where I would place my bet. Now, on the first question, I think sometimes people expect more of impact transparency than we get out of financial transparency. You know, financial accounting is an art more than a science. Financial accounting rules change on a monthly basis. And it's taken us 9 decades to perfect our financial accounting system. And I don't think we should expect to solve every question within, the next, within this decade, since we're talking about the SDGs. But we can begin to influence the behavior of companies very significantly and deliver better returns for investors in the process. And so we will change our impact accounting principles over time. There will be some unintended consequences. We will have to cope with them. But the important thing is to realize that this is really the new frontier for capitalism and for society. We cannot continue with a system where companies create huge environmental and social damage in their pursuit of profit, and governments tax us all in order to try to remedy it. It's a self-defeating system. Governments can never tax us enough in order to remedy the damage. If I tell you, Catel, that the 1,800 companies' environmental damage in the Harvard data set amounts to $3 trillion a year. How can governments cope with that? They can't. They have to prevent this damage from being created. And the way to prevent it is to allow investors to do so. Governments don't need to ban it. They don't need to ban fossil fuels. Fossil fuels are going to be declining because investors realize that it's a bad investment. Now, that's not to say the governments don't need to ban anything. I'm just saying if you have the transparency, market forces are going to do a big part of the job for us. But let us not expect that impact accounting can be absolutely perfect from the start. Like financial accounting, it will need to evolve.
Thanks for that answer, Ronnie. And I think we've got time for one last short question, and another question from the audience, looking about your leadership experience in managing a fund. So it was reported that when you left Apax, that you were setting a standard for other leaders in your firm to follow, and specifically to know when to move on and allow others to succeed and lead. So the question is really, what lessons would you share as a founder and a leader and dealing with this challenge of legacy and moving on?
So succession is not an easy process. It's certainly not an event. It took me 7 years to plan my succession, to put a constitution in place, part of which, as you said, Aubrey, was that everybody would leave the firm at the age of 60, and I would be the first to do so. And I think the culture of a firm is what determines, at the end of the day, its longevity. Now, when I left Apex, it didn't matter to me whether I drove a very hard deal with my partners and maximized the financial amount that I could take away. I wanted to give Apex the opportunity to thrive as a leader in, in the private equity and venture capital area. And my successors have done that. When I left Apex, we had 20 billion under management. Today, we have more than 50 billion under management. I think the values of the firm have continued pretty much untouched. So what lessons have I learned from it? I've learned, I suppose, that you need to be clear about your objective in life. When we set out, we have immediate priorities. We want to make money. We want to connect with an opportunity that can enable us to do so. We want to attract talent to support us to achieve it. And then later on, when we become successful, we begin to turn our minds to the question of what happens after us when we leave the leadership of our firm. And we tend to think in terms of let's make money first, and then let's be generous afterwards as philanthropists. I think what the whole impact thinking is doing now is conflating these two things. You can actually pick a career where you do good and you do well at the same time, where you improve the environment and the lives of people, as well as building a huge fortune for yourself. And I would set my sights today, if I were an entrepreneur, on becoming an impact unicorn, a venture that doesn't just become worth $1 billion, but that improves the lives of 1 billion people.
Thank you very much, Ronnie. I think it's a great way to end, as with your inspirational notes for our students. I think they also took good note on the fact that this whole architecture and framework is still to be built, won't be built in one day, and that they will have to contribute to that endeavor. So thanks for also reminding us of this, for allowing us to push you gently and to also try to bring some controversy on this important agenda. Thank you so much for being with us today. To all, everybody, read the book. Sorry, I interrupted you. Do you want it?
No, thank you all very much for your interest in the subject, and let's make it happen together.
Indeed. Thank you, Aubrey and the Endeavor Club, for being our partner for that session. Thank you, Ilian, for joining. You can wave the book of Ronnie also so that everybody sees it one last time. Thanks to Accenture Strategy for partnering with us. I also
I think it's important to say that we're not just selling the book, to make profit, but Ronnie is actually donating all the profits to what actually?
To charities. No, to impact charities.
Yeah.
To charities. But I think that we're promoting the book because I think it does change a lot of perspectives, and I think that it inspires people. So it's, thank you.
I couldn't also wrap up by thanking the team. I need a slide here so that you put faces on people who work hard in the background you don't see but make everything happen. Thank you very much to all of them. You see, it takes a village. We also wanted to say that this afternoon at 3 p.m. CET, the INSEAD will be launching the Students Impact Club. So we're continuing that conversation. We will be also discussing during our SDG week impact entrepreneurship from humanitarian perspective, from a young entrepreneur perspective. We'll be discussing sustainability in careers, and we'll be also discussing impact, equity, diversity, and inclusion. So stay with us for the rest of the week. Join the sessions. It's all free. You're welcome to register. Thank you, everybody, for joining today. All of you, goodbye and stay healthy.